Hello and welcome to this month's Bytesize. I'm Benjamin Caveen, your host today, and I'll be talking about bundling in the banking industry and how we use subscriptions to transform those loyalty programs into meaningful customer relationships. We've recently released a new report called Loyalty Pays, and we'll be taking you through some of the key areas backed by subscriber data. Feel free to scan the QR code, which I'll show right now, like magic, and you can get access to that report. There's a lot of stuff in there, so I do ask you to check that out because it is a great report in this space. So today I'm going to be joined by Andy, who is in our product team. Andy, welcome. How are you doing today?
Very good. Thanks, Ben.
Good. Right. I think we'll get cracking straight into the content, shall we? So we mentioned already the report has been released. So this is based on 5,000 US subscribers. It features a lot of interesting data in there from our other reports from the earlier in the year. The QR code will be in the right hand side now, that like magic. And we've also got a lot of other data in there as well from Accenture, Boston Consulting Group, RFI Group. So do check it out, and we'll be covering some of that throughout this session. So Andy, the report paints quite a stark picture in loyalty in banking. So Gen Z are now only holding accounts on average for 5 years. Switching has become so easy. It's one click, one tap away. So why are traditional tactics like cashback and points no longer enough?
Yeah, really good question, Ben. With the latest developments, obviously, in digital banking, it's so easy now for any of us to just go online 24/7 and to just open multiple accounts. We can get virtual credit cards. We can set up buy now, pay later accounts. There's more choice than ever. And that basically means it's really easy for us to switch and transfer funds. With all those digital banks and cards, they all offer the same cashback and point schemes. So, basically none of them end up standing out. So, today's digital first customers, it's just not exciting. Those customers are already familiar with, some really good digital rewards that are available elsewhere, usually from their mobile operators. And that's things like, streaming with Netflix or Disney, perhaps, shopping apps in the US with, Walmart Plus, for example, or ride-hailing apps with, Uber and Uber One. It basically means a couple of dollars of cash credited or some points to use somewhere or a voucher for a free month of something just end up feeling really sort of outdated and old-fashioned.
And I don't think, I've not really personally used these before either. I mean, it's just a little bit of a screenshot here from on the left-hand side. I bank with NatWest, and I have got the NatWest rewards account, and that is, I get a particular reward is if I've got some direct debits set up. I think it's 2 direct debits set up per month. I get a £5 benefit cashback there on a monthly basis. But we're talking about what's the benefit there really of when do you actually take that out? And it's probably every 2, maybe 3 months. I literally talked to you about before. I think I've got £17.74 in my rewards account to withdraw at the moment. So, but what you're kind of talking about here is more like everyday value, right?
Yeah, absolutely. And don't go and spend that money all at once, Ben. Banks need to be relevant in the daily lives of their customers today. Not just every once or twice every month. Most banks, they offer some sort of cashback incentive. There's a couple more examples on screen there with Bank of America and Monzo. But again, there's no real clear differentiation. And as we continue through this chat, we can point out where subscriptions can really enhance customer engagement.
Yeah, I was keen to share some stats here that feature in the reports from earlier in the year. So this is from our subscription assemble report that took place. You can scan and access that report in the top right hand corner. So this really kind of frames the conversation we've got today on subscriptions. So $900, nearly $1,000, right, being spent a year on subscriptions is the latest figures here. And we're managing around 5.4 subscriptions each. That's quite a number of subscriptions there. And I think this is the bit that's really interesting for the banking area, is the fact that 70% of them are saying that there's certain subscriptions that they'll never cancel. We call these the kind of forever subscriptions. And for me, that's obviously like kind of Netflix and Amazon Prime. I probably would never ever cancel them. But banks that can connect themselves with those type brands, that's where they get the real big benefit here. And customers obviously love using these on a daily basis, and that's far more powerful than a few pounds or dollars here and there, isn't it now?
Yeah, absolutely. I mean, subscribers are also becoming more savvy about trying to find these best deals for their subscriptions, especially those forever subscriptions. And it's created a boom in the indirect distribution of subscriptions. Telcos have traditionally been doing this for many years now, but we're now seeing more banks, retailers, even companies like automotive, airlines, hospitality, utilities, all trying to use subscriptions and the stickiness, that longevity of a subscription as part of an acquisition and crucially a retention strategy.
So yeah, obviously there's a few examples on screen now. There is some out there already. There is these kind of single subscription offers that exist. So with like the likes of Disney Plus that's being shown on there, Uber, as you mentioned, maybe HBO Max. Isn't that enough, would you say?
Not really. Firstly, most of these offers tend to use vouchers or affiliate links today. So, you find the offer, you think, great, you click on the offer and it takes you straight away to the subscription company to sign up. So you're straight away from the bank to the subscription company. And I guarantee the subscription company, the first thing they'll ask you for before they give you the free trial is for you to enter your card details. And that's going to cause significant drop-off. So a large number of customers that click that great offer don't actually take the offer up. And since we now have these new online cards and accounts that's so easy to sign up for, it's super easy to use a different bank's card to do that payment, especially with browsers auto-completing the payment details for you. So, effectively the bank's lost that ongoing relationship straight away as soon as the customer clicks that link.
Yeah, and I suppose to add on there as well, so the customer it feels quite clunky, the process, right? Because you're kind of going, not really activating it within the app, you're kind of going off to a different place. And obviously all of these different offers have different terms and they have different experiences, and you have to kind of remember to know where to go and cancel. It probably actually feeds into the admin headache even more with managing these multiple subscriptions, doesn't it?
Yeah, exactly. I mean, customers, they often discover that, when they get through to the content brand, that there's a better deal available for them, quite often directly with the content brand, and there's no cohesive user journey for them at all, as they, as you say, move out of one app into another ecosystem to do that sign up. There's alternatives, without going down the voucher route and the affiliate program route, where a bank can now deliver a consistent experience across all of the subscriptions they're offering. That gives a higher success across the board, and crucially, it keeps ownership of that valuable customer with them, so no more handing off and forgetting to the content brand. And of course, on the back of that, because you're owning the customer more, there's new revenue potential from upgrades and add-ons, which we'll come back to in a moment. The customer, of course, gets the really simple offer or reward experience. They're using the brand they trust. They're still within the banking app, and they can immediately associate the value of that offer, of that reward, directly back with the bank because they're still within that experience. And the subscription brands, of course, love this because sign up and billing are all streamlined. You're using the customer's trusted bank account or cards on file, which means there is no payment screen, which therefore gives them a far higher success rate on sign up. And of course, the bank account can last for years. So you've now got that stickiness between the bank account and the content. So retention of the customers is also significantly higher for the subscription brands.
Okay, so we've spoken about kind of single offers here, and we're going to go talk a little bit more about this kind of advancement now. So how do we move from these already existing single offers into that better bundled loyalty for banks?
Yeah, sure. To engage with most customers, the big recommendation here is really about choice. If you look at things like Revolut, which are doing a fantastic job with their loyalty schemes, they went much further with their tiered propositions. If we look at their top tier product, Revolut Ultra, they're giving you £4,000 worth of subscriptions bundled in that's not just attractive. It makes Revolut part of the customer lifestyle. It's a recurring touch point. Things evolve and change. It's not a one-off incentive. And sure, Revolut might be missing some of the bigger names like HBO Max, Apple TV Plus, or music, etc. But that will come.
And it's the sort of thing that people talk about, isn't it? So you hear people say, "Oh, my Revolut plan's got X, Y, and Z," and all these different things that you're talking about, and suddenly that bank is part of that everyday story, which is really, really important. And I personally signed up to Revolut Ultra to kind of see what it was all about. It does make you kind of pop in and out of the app more regularly, and keeping that kind of brand, that banking brand, front of mind. And I actually used, the travel insurance that was part of the access and the airport lounge access a few times as well when I was traveling. And I also actually traded some stocks and shares as well. So it kind of really helps kind of, use more of the first party service of the bank, which is really important for them because of those kind of additional touch points with subscriptions. So there was really good value in that kind of tiered approach. And I've had some really good experience from that. I want to talk a little bit more about kind of customer segmentation with you, if I could, Andy. Now, I know banks, they know their customers probably better than anyone. But what are some of the most exciting ways that banks can engage with these particular customer segments?
Yeah, sure. So, I mean, banks know what we spend on in detail. They know how often we spend. They know what we're spending our money on. So it's very easy for them to use that to target the right offers far more precisely than anybody else can. So again, if we look at some of those demographics that banks want to attract and want to retain, if we look at Gen Z or the younger professionals, then streaming apps, gaming, AI tools, things that they're already engaged with and paying for are very attractive. If we go to perhaps the older generation, it could be digital enablers like health apps or fitness apps, learning services like maybe learning a new language, and things that help encourage them into the digital banking space. Students, coming to the end of their course, looking for first jobs, ideal opportunity for a bank to grab the customer while they're young and ensure that first salary is paid into the account, and hopefully many more to come. So again, like Gen Z, streaming, gaming, music, AI tools, productivity tools would be a great offer to put out there. Don't just think about local services either. I mean, if we look at the expat community, quite a few banks try to attract expats coming from different countries. So look at the services from those countries, services that are more local to home for those customers. And of course, for higher tier, higher value customers, you can create premium tiers, with pick and choose or super bundle models that really differentiate and make those the most sticky of your customers.
Yeah, really good points there. I want to talk a little bit about dormant accounts because I know this is a big challenge for banks. Myself, I've got 4 bank accounts. I've got my bank that I get paid my salary into, that I usually have my bigger payments, like my mortgage payments, coming out of. I've got my Monzo, which I use for daily spending, and I've got a joint account with my wife through Monzo. It's easy to transfer money and everything because of the user interface. And then I've got 2 bank accounts, which, I've got my Nationwide Building Society, which was set up for me as a kid by my family. I don't use it at all, so I class that probably as a dormant account. And then I've got my Revolut account, which I've kind of used for testing purposes, basically, and to access some of those subscriptions. So I classify I've got 2 dormant accounts. So it's obviously and that's just one person, right, with 2. How can bundling help keep these kind of active and kind of revive them if they've gone quiet?
Yeah, sure. And I'm surprised, by the way, you've only got four accounts so far, but you need to work on that. So bundles naturally give people a great reason to open their banking app, at least monthly. You're going to go in there and sort of check the subscriptions and so forth. Maybe there's choices, so you can swap subscriptions after a period of time, to keep the customer engaged. But it's also a really easy way to use subscription perks to drive customer behavior. For example, you want the customer to deposit their salary into their account every month. So each month you deposit your salary, you get Netflix for the month, perhaps. Maybe each month with our mortgage, will give you Disney Plus for you and the family to watch in your new home, or based on your spending, the more you spend on your card, the more subscription benefits that then unlocks. And we see a lot of that in retail working very well. It makes the bank part of your everyday life. The more you do with the bank, the better the rewards, the more you get. It's more compelling than points. $10 worth of Netflix, to me at least, feels far more valuable than perhaps $6 worth of points in my account. It's more relevant. I actually use the service rather than wondering what to do with it.
Yeah, very interesting points there. It's more on the kind of behaviours that are happening within the bank, right? But yeah, some data to support this as well on the kind of bundling space. So we can see that 62% would rather bundle and then sign up to individual services. So there's a great opportunity there for banks to capitalise on that. 29% saying they'd actually leave their bank or financial institution, go elsewhere if that bundle or a bundle was made available somewhere. So there's a bit of a risk factor there, really. And that actually grows to nearly 50% for the younger demographics. I know you talked about before in the customer segmentation part. So it's a really, it's an interesting kind of proposition there, how bundles can really hold on to and find new customers coming through. And Revolut shared some interesting data that's available in the public sphere. They actually added 15 million net new customers this year, which is crazy numbers. And it's, it really does showcase that kind of value of tiered accounts, and especially on their profits as well. I think they announced 1.4 billion of profit or something ridiculous like that. So it's crazy figures here. And they're really positioning themselves as this kind of full spectrum super app. And I know people have this aspiration to be a super app, but they're really doing a really good job in that space. And I know a lot of banks are aspiring to be like Revolut, or look at Revolut as a kind of a pioneer in the space. Well, some people might just say that bundles really are just an extra cost. So, Andy, is this just like a loyalty expense, would you say, for a bank?
Sure. Acquiring and retaining customers, it always has a cost. But using subscriptions is clearly delivering a significantly higher customer engagement, better relevance, and higher delight than the alternatives that we've discussed. But don't forget, it's also a revenue opportunity. Firstly, you're ensuring that your customers' subscription payments go through your card or your account, and not some auto-populated other bank account that the customer has. Secondly, most of the included bundles, so the ones that you get as part of your account, will start with the basic or with ads tier. Most customers, you're going to upgrade that to standard or to premium or to the family plan. And all of those upgrades are seamlessly billed to the customer's bank account or card. So again, that's additional revenue that comes through to your account. And thirdly, when customers see how simple it is to discover and manage subscriptions all in one place, as you mentioned with the stats earlier, they're far more likely to add more subscriptions into that. So even if you're giving one away as part of the account, always make sure there's a choice to add more afterwards. And if you're managing these much loved subscriptions, these forever subscriptions, then your first party service, your bank account, your mortgage, becomes so much more desirable and sticky because you've added in these forever services alongside.
Yeah, and the example on screen is the kind of Netflix flow, right, of the ad tiers going through. And there's quite a lot of this kind of similarities across, definitely in the streaming space, but even in some of the other verticals as well.
And that clearly shows how much extra you can get from just enabling those upgrades to from the with ads to the standard or premium.
Absolutely. So you talk a little about managing subscriptions, Andy. So what does that kind of look like in practice?
Sure. So every subscription service sign up and management traditionally is different. The terms before you sign up, how customers are notified when perhaps a free period transitions to a paid period, or how a subscription is cancelled. Does it stop immediately? Does it end at the current paid for period? And sometimes the cancel button's not easy to find either. Nobody really wants customers to cancel. But a bank working directly with a content provider and taking ownership of their customers' subscriptions, they can standardize all that. So they can deliver consistent terms. They can deliver the simplest, consistent sign-up experience. One simple cancel button in the bank app itself. The benefit of managing it all in one place is immediate. The billing is really simple. It's seamless. Upgrades can happen automatically. And because the bank owns the process, the consumer can clearly attribute value back to the bank, and it helps grow trust.
No, thank you for walking through that. I want to talk a little bit more about kind of indirect distribution, if I may. So this is obviously buying a subscription from someone else rather than the subscription brand itself, right? So that indirect means 68% of us now are buying at least one subscription indirect, which is huge, right? That is, it's a huge amount of market, and this is growing, and we're seeing that kind of scale up as we look at this and track the market. And it's usually really for two main reasons, I'd say. There's definitely along the list to this as well, but these are the two main reasons that we saw from our research. It's convenient, so it's just easier to add to your existing bill than setting up a new payment directly with the provider. And also that it could be a better price. So it could be just the offer is more appealing with the price in particular. And telcos have been doing this for years, as you mentioned. They're in the primary position to do this. Due to most of the content is actually being consumed on device, usually on the mobile, or needing a connectivity aspect to it. However, in the banking space, obviously now with this kind of shift more towards digital banking, banks can now start to lean into this space a lot further, can't they?
Yeah, absolutely. I mean, telco started with hard bundles. So if you remember, you get Netflix or Apple Music included with your mobile plan. They've since then moved into soft bundles where you can start to pick and choose from a selection of providers. And they've made it possible to really easily add add-ons at any point within the billing cycle, to keep things fresh. So upgrades or additional services into that. We're now starting to see a shift towards a lot more complex, advanced bundles from the telcos. A great couple of examples here. So the one on the right-hand side is from Verizon, where they've included Disney Plus, Hulu, and ESPN into one combined bundle. And more interestingly, they also combine Netflix with HBO Max into a bundle for their customers, which seems to be really popular. It's not just Verizon, Comcast with Xfinity StreamSaver. They include Peacock, Netflix, and Apple TV Plus, all for one attractive price. So this is a common trend that we're seeing sort of across the telco and broadcast areas. The next step on from this, is where we then start to get into a full subscription marketplace that gives the consumers a simple single place to go and discover and manage any subscription. Optus SubHub in Australia has been going for a few years now, delivering some great results. More recently, Telenet Marketplace in Belgium is another great example of that. And I think there's a case study that you've thrown up there as well, Ben, for that one.
Yeah.
I
was going to say you can access that through the QR code, which is just showing now. You can scan that and get it. There's a big, quite a decent amount of data in there that's been shared from Telenet. That's really interesting.
Yeah, it's a really good one. Well worth a read. The impact really has been huge for these guys. I mean, Verizon publicly reported 75% acquisition growth, with one of their recent bundles. Some great marketing, great attractive bundle, and they've reported quarter on quarter churn reduction. Churn's down by 60%, which is massive. And they've directly attributed that to their My Plan and My Home product bundles. So both for the mobile and for the home internet services. And also Telenet, as I mentioned, a lot newer, but they've already reported churn reduction by 26% for consumers that have taken a bundle with them.
Absolutely. And so these subscription hubs, you may have seen the term super bundling being used before. And by definition, this is where customers can basically pick and choose from a whole array of subscription services and pay for and manage them all in that one place. And data really shows that this is what people want, right? This is, 63% saying they want that one single platform to manage those subscriptions. 57% saying they'll be more loyal to a brand that provides that content hub. And then 62% would then go and recommend that provider if they're offering that super bundling service. So this is really the impact of this would just be huge on the bank, for a bank, if they could be that provider of the subscriptions. So you're saying that banks can kind of learn a lot from telcos who are very active in this space. Could you share a little bit more information on that for us, Andy?
Yeah, absolutely. The principle here is that it's really about daily relevance. Telcos added entertainment to their connectivity services. Banks can add lifestyle value to the customer's money. Banks obviously had the added advantage of increased trust. They've got clearly far better data around customer spend. And as a result, I'd expect them to do a much better job of targeting and delivering the most engaging subs to the customers, far better than telcos can.
Yeah, and I thought this data that's on screen now is really interesting as well, from Parks Associates in the US. And they're really sharing kind of the impact of more services being bundled as part of a broadband and fiber package. And you can see that correlation is very positive between the more services that are taking up, the happier the customer will be. And I think this can correlate quite easily with other verticals as well, like banking. So it's a really interesting way of kind of showcasing that bundling subscriptions can really help with kind of customer happiness and loyalty. And we talked a lot about kind of the reseller perspective, aka the bundler, as we like to call it. What about the subscription provider themselves, Andy? Can you tell a little bit more why they're interested in bundling?
Yeah, sure. So, subscription leaders today, they're struggling with the rising ad costs. There's a lot more competition. There's subscriber fatigue as their products are more mainstream. So it's no wonder really that 90%, as you can see on screen here, are saying that they're increasing investment in indirect acquisition this year. The interesting part for this discussion is just look at where those decision makers are looking to bundle their services. Nearly half are targeting banks and financial institutions now, which is ranking higher than the most prolific bundlers, the likes of telcos, ISPs, etc. Which wouldn't have been the case a few years ago, which I think is fascinating, right?
Yeah, absolutely. And this particular, the data from this is from this report that's showing on screen now called Gravity Shift. You can scan the QR code and get access to that. It goes in a lot of depth of the kind of subscription leader perspective and the executives that have been surveyed on this. So very interesting around what they're struggling with direct to consumer, and how they're moving and investing more in the indirect channel. So this does sound brilliant, Andy. I think we want to kind of know a little bit more how it will work, and kind of, it's obviously quite a complex thing, but there's a way of banks being able to act quite quickly here to really take ownership of this area.
Yeah, absolutely. It can be complex. You've got multiple content partnerships that you have to deal with. There's the technical integrations, the operational requirements, which, if we look at what telcos are doing, and how banks are now turning to the digital vending machine to solve that for them. The digital vending machine is designed to take care of all of those aspects. Allows you to create and launch offers in weeks instead of months or years, as we've seen in the past. And time really matters. As we all know. Revolut, they've already built a huge momentum because they moved first. And traditional retail banks and a lot of the other digital banks, need to catch up. They can't afford to hang back.
Yeah, and you've touched a little bit there on the DVM. So what's actually involved, and why should banks use it?
Yeah, sure. So once you've agreed that building a consumer relationship with subscription bundling is the way you want to go, you need to understand what's actually involved in doing so. So the slide that you can see here, the first thing, I should go back a slide. Sorry. Perfect, thanks. The slide you can see here is, the first thing you need to do is to connect the subscription brands that work best for your consumers, your brand, the campaigns you've got planned. And the DVM provides partner management to take care of that. We've also got a growing number of what we call pre-stocked content partners or pre-stocked partners, which help deliver speed to market. They're ready to go. You need to build great offers themselves. Is that fully included bundle, a promo period, discounted multi-party bundles? And again, DVM takes care of all of that creation. You need to distribute those offers, get them in front of your consumers through your apps, your website, campaigns you're running. And DVM provides white label consumer experiences to take care of that. And once the offers are taken up, you then need to deal with managing those offers, the phases, free to paid, the billing requirements, handling upgrades, for example, or add-ons, and the revenue that generates. You've got to make sure that everybody, the content brands and yourself, the banks doing the payments, are in lockstep, to make sure everything's aligned. And again, the DVM does that. And finally, you've got to review and evolve and make sure that you're driving success, which again, we've got covered. So if we go to the next slide. So, standardizing on the DVM, it allows banks to launch everything from simple bundles right the way through multi-party bundles, right the way up to full subscription marketplaces with absolute ease. And because we're an industry standard for this, because we're a single solution in the market, it's constantly evolving and growing. We've got new partners joining all of the time, new content services joining all of the time, which opens up great, exciting new opportunities for everybody involved.
Thank you, Andy, for sharing a bit of information there on the digital vending machine. I think this is a great opportunity now to get any questions as well into the chat. I'm sure there's a lot of content we've shared there that could be interesting and thought-inspiring. Feel free, we've got some time at the end to wrap this up and kind of talk a little bit more in detail with your questions. We are live streaming, so this is live, we're here. So we are humans and ready to go. Feel free to put those in the chat. But Andy, so if there's one message you kind of want to summarise, basically, of what people would take from this report, what we've learned from spoken about today, what would it be?
I think it's probably that subscription bundling, it's the new loyalty currency. Banks that move early are going to secure deeper relationships, more engagement with their customers, and of course new revenue streams, from all of those subscriptions and upgrades. Definitely don't wait around. Don't risk being left behind.
Perfect. Well, thanks, Andy. I think that takes us to the end of the content we're going to talk about. Obviously, thank you very much for everyone that's joined. If you'd like to see the full picture, you can, scan the QR code, which has fallen off the screen, but I'll put it back up because we're live. There we go. You can scan that QR code, get access to the full report, and if there's any questions off the back of the report, feel free to reach out to us directly as well, and we'll be more than happy to answer them. Let's have a little look in the chat. I've got one here that's been sent through to me, Andy. So what happens if a banking customer already has a subscription that has been offered by the bank? So if the offer's there, but you've already got it. So for example, I've got a Netflix account. I see this offer that's part of a new tiering. How does that mechanism work?
Yeah, that's a really good question. I actually get asked that quite a lot. So two answers to that one. First one is increasingly the content brands are allowing customers to migrate their payment from direct to indirect through the bank. And clearly they do that because they know they're going to get extra stickiness, extra retention from the customer as a result of it being associated with the longer term bank account. The second thing is that, that really clearly shows us that banks, telcos, whoever need to offer more than one subscription to their customer. Give the customer a choice. It might not be that you've already got Netflix. It might just be you don't want Netflix. You'd rather have a sports service or a fitness app instead of the Netflix that's being offered. So I'd always recommend give a choice of 3 to 5 things. That's going to give you the best uptake.
And that we kind of alluded to that, didn't we, earlier in the session, when we've seen single offers that are existing in the market right now, and there's not a huge amount of choice. You kind of fix to that one that you're talking about. So yeah, I think that's a really good point.
And I think that also falls into the trend we see where people swap and change between their subscription services frequently. People tend to graze on services a lot more these days outside of your forever service you never cancel. Some of the others you'll dip in and out of. So provide choice, allow customers to switch between things.
Yeah. Okay. Andy, I think we'll call it there for this particular session. We'll be joined back again next month for another session. So watch out for the promotions for that one. But again, thank you very much for everyone that's joined. We really appreciate your time and effort on this. We've got one question that's come through. Oh, look at that! Just before I was finishing. Which content providers are allowing the switching to occur?
There's quite a few, and it depends on who the partners are. But we have seen that happen with everything from the likes of the Netflixes to the Disneys to the Amazons. So some of the big ones. Smaller brands definitely are more up for it. The larger ones that have got a lot of existing penetration in a particular market are the ones that are going to be less keen on allowing that switch unless they fully understand the additional retention benefits that they're going to get from the partner that they're working with. A lot of them are open for it. It's probably worth, if there's an interest there, have a chat with us offline, and we can help guide on the good ones to go for that.
Cool. Thank you very much. I hope that answered your question. And then, feel free to also reach out to us. There's a contact us QR code that's on there. If you wanted to speak to someone from our team, we're more than happy to address any questions privately. Thank you very much for joining. Andy, thank you very much for your time. Pleasure. And I'll let you go back to the rest of your day now. Thank you very much. And thanks for joining.
Cool. Thanks.
Thank you.